How do REITs work? Hey everyone, welcome to another 101 video. This week we're going to go through how do REITs work. You may be familiar with REITs, you may know a little something about them, but most people out there actually don't know too much about REITs and how they operate. They kind of see them as this complex financial instrument, somewhat related to real estate. You may know that REITs, to be a REIT, you have to pay out 90% or more of income that comes in a year. Otherwise, you lose the REIT status. And in exchange for that, you get some sort of tax benefits. But that's usually the extent of what people know. So we're going to go through today how REITs actually operate. What are some of the advantages of them? Why they're even in existence? They wouldn't exist if they didn't serve a purpose. So we're going to dive into this today. So I should point out, there are a couple of different types of REITs. The main one is equity REITs. So that's an actual operator REIT, and that's what we'll be talking more about today. And there are mortgage REITs that own papers, notes of loans. It's a little bit more complex and not really in the scope of what this channel or this video is about. So we're going to talk more about equity REITs. But anyway, let's dive into it. First point is REITs are securities or shares in a CRE company that owns real estate. Now, the type of real estate that the company can own could be multifamily, it could be commercial office, it could be industrial, it could be a mix of different asset types. It really comes down to what the flavor of the commercial real estate company is and their portfolio. So when you own shares in it, you're not actually owning the real estate itself. You're owning shares in the company, and these shares are tradable, just like if you bought shares in Apple or McDonald's stock. And they can be public, they could be private. So publicly traded REITs, you can look them up. I believe there's maybe 17 multifamily REITs that are publicly traded, a whole lot more that are not publicly traded, but they show up like shares on of a regular company. The difference is that they avoid the double taxation that most corporations go through. So if you're not familiar with what double taxation is, when you have a C corp and your company takes in profit, the company pays corporate taxes on that income. Now, when you make a distribution to investors via dividends, those investors also have to pay taxes on the income they get from the dividend. So it's taxed at two different levels, and that kind of whittles down a lot of the profits once it actually gets into the shareholders' hands. REITs skip over the taxation of the initial income, and only the investor gets taxed at the income level. So that's the big advantage of REITs. That's why they exist, and that's why they're very popular. So just think of them as shares in a commercial real estate company's portfolio. So what do? They offer liquidity and diversification. So liquidity, if you think about it, especially a publicly traded REIT, you can buy and sell that REIT. You can buy and sell it multiple times in a single day. Very different to the actual nature of real estate itself. So usually with real estate, if you're investing in a fund or a single deal, your money could be tied up for several years, 5, 7, 10 years, depending on the type of deal. It's very illiquid. Just like the property itself, you can't just turn around and sell it the next day. Even if you do want to sell right away, it's going to take some time to market, a buyer to come in, do their due diligence, and actually close on it. So REITs offer this liquidity that real estate typically does not offer. And of course, you get some diversification. So you're not buying into one specific property. It's usually a whole portfolio of properties, especially if it's different asset types and classes. You could be buying into. They're usually higher class A assets we're talking about here. You won't see Class C REITs not even class B. These are usually trophy buildings in, the best areas, newer builds. Those are the kinds of deals that REITs deal with. Next thing we're talking about is lower or even no leverage. So a typical fund or multifamily syndication, you might be looking at leverage anywhere from 60 to 75% depending on the market conditions. REITs actually work the opposite way. They work with little or no leverage. I think the average leverage might be 30%. And it's not a traditional loan. They're not going and applying for a loan with a lender. They usually have some sort of partnership with a lending institutional lender, and they have like a revolving line of credit, which they can, continually take money from, refinance, raise equity. They have a lot more financial levers that they can play with. So even with lower leverage, what does that mean? Usually means that cash flow is better, which is important for actually creating the dividends. But it also means that they have different advantages and disadvantages in different interest rate markets. So it's interesting that REITs actually perform better when interest rates are higher. It's usually the opposite with traditional investing. When you're purchasing property, if you're in acquisition mode for single property deals, if interest rates are higher, that's usually not a good thing. Because REITs are lower or no leverage, they're not so hung up on what interest rates are at a specific point in time. So say for instance, now we're in a higher interest rate environment. This is actually good for most equity REITs. And the reason being is that it knocks out a lot of competition. Those who rely on leverage are going to be knocked out by interest rates. So these REITs can actually come in and swoop up properties with little or no competition, whereas in lower interest rate environments, there is that competition there. So that's an interesting part of REITs that not a ton of people really talk about, but they do thrive in higher interest rate environments. They, of course, create passive income. This is a big part of why people invest in REITs. They do get the income, just like investing in traditional real estate. And not all stocks, especially these days, give out dividends. So investing in a REIT can actually be good passive income, especially when you're coming from the equities market. It's not going to blow you away. You're not going to get the kinds of returns you would investing in a value add single deal or even a fund. But that dividend component is there, which is very attractive for a lot of people that want that safety net, that diversification, and also that passive income coming in. Acquisitions through UPREIT. Now, a lot of people haven't actually heard of an UPREIT, but this is one of the kind of financial instruments where you can take advantage of REITs, and the REIT manager can actually increase their amount of acquisitions without necessarily coming up with more cash or debt. So what an UPREIT is, this is effectively, remember, we're talking about a company here, a company that has shares. They approach an owner of a multifamily building. It can be any asset, but we're talking multifamily here. And they can say, hey, instead of a traditional purchase where we give you, we close and you get X amount of cash from the sale, we're going to either give you shares or a combination of shares and cash in exchange for your property. And what that does for the owner, it means that they can actually defer a tax event. It's not a tax event if it's purchased via UPREIT. So that can actually be very advantageous for the owner who may have some significant capital gains on their horizon if they do a traditional cash out. Now, if you do run a REIT, obviously the sale is to the owner to show that you are a stable and reliable REIT. The bigger you are, the more easier it is it's going to be to convince them of an UPREIT. If you're a startup REIT and you've done no deals and you're trying to convince owners to do an UPREIT, it might be an uphill kind of sell because you don't have that track record. And if you give them shares in something that they don't really trust, it's going to be a tough way to convince them to go along with that. But if you can get it to work, UpREIT can be a tremendous way to acquire properties without really going out of your way and having to raise a ton of capital or debt for. You can actually get that raised through the owners themselves, and you can scale a portfolio quite quickly. Stock market volatility. So if it is a publicly traded REIT, even if it's a privately traded REIT, because they do kind of work, hand in hand or have parallel features to them, you are at the whims of the stock market. If the stock market drops, you could definitely get volatility that has actually nothing to do with the underlying assets themselves. So if, say, the S&P or the Nasdaq drops suddenly one day, you might see that same drop in these REITs, even though the underlying real estate has not gone down in value. But you are kind of at the whims of the stock market when it comes to REITs, and that can actually be a good opportunity for some people. But if you are relying on dividends or to cash out, then it could be rough depending on what period you're in. That's all we have time for today. Thank you again for tuning in, and we will see you next week.